That $300 rate you paid is not static. It is the result of a complex optimization problem solved in milliseconds by a revenue management system. This system analyzes historical booking pace, competitor pricing data scraped via rate shoppers, and real-time demand signals like flight load factors and local event calendars. Hotels operate on perishable inventory, meaning an unsold room tonight generates zero revenue forever. The core objective is maximizing RevPAR, revenue per available room, which balances occupancy and rate. The system dynamically adjusts the price floor and ceiling multiple times daily, based on predicted occupancy thresholds, ensuring the hotel captures maximum consumer surplus across different market segments. This algorithmic approach is the fundamental driver behind rate variability. Before calculating profit, the hotel must cover its operational costs. Approximately 40% of the $300 rate covers fixed costs, including property taxes, debt service, insurance premiums, and essential utilities like base electricity and water supply. Variable costs, such as housekeeping labor, guest amenities, and laundry services, account for another 20%, fluctuating directly with occupancy levels. The crucial metric is gross operating profit per available room, or GOPAR, which measures profitability after deducting departmental expenses, but before considering capital expenditures or corporate overhead. A healthy GOPAR margin often targets 35 to 45% of total revenue, dictating the minimum acceptable average daily rate required to sustain operations and satisfy ownership returns. The distribution channel significantly impacts the net revenue realized from that $300 booking. Online travel agencies, or OTAs, such as Expedia and Booking.com, typically charge commissions ranging from 15 to 30% of the room rate. If the booking is $300, the hotel might only receive $210 after a 30% commission. Direct bookings made through the hotel's own website or call center are far more profitable, incurring only the cost of the booking engine software, credit card processing fees, and digital marketing spend, which usually totals less than 8%. Hotels strategically use rate parity agreements, ensuring the OTA rate is never lower than the direct rate, while simultaneously incentivizing direct bookings through loyalty programs and value-added packages to mitigate high commission leakage. The entire pricing ecosystem relies on integrated technology. The Property Management System, or PMS, is the operational backbone, handling check-in, billing, and inventory management. The Central Reservation System, or CRS, acts as the hub, distributing inventory and rates across all channels, including the global distribution system used by travel agents. These systems communicate via two-way interfaces, ensuring instantaneous rate updates across all platforms. Failure in this integration leads to rate disparity, or worse, overbooking. Modern systems utilize cloud architecture, allowing real-time data processing necessary for sophisticated algorithmic pricing decisions, moving beyond simple spreadsheet forecasting.
The revenue manager's primary task is forecasting demand with high precision, often 365 days out, broken down by market segment and day of the week. This involves calculating demand elasticity, determining how sensitive consumers are to price changes at specific occupancy levels. If the hotel is 80% full for a future date, the system increases the rate significantly because demand is inelastic. Guests needing a room are willing to pay a premium. Conversely, if occupancy is low, rates drop to stimulate demand, assuming high elasticity. Accurate forecasting minimizes spoilage, which is unsold inventory, and dilution, which is selling rooms too cheaply when higher rates could have been achieved. Hotels employ various pricing fences to segment the market and capture different willingness to pay levels. The best available rate, or BAR, is the standard, unrestricted rate. Fenced rates include non-refundable advance purchase rates, which offer a discount, typically 10 to 20%, in exchange for the commitment of prepayment and cancellation penalties. Corporate negotiated rates are deeply discounted, often 25 to 40% below BAR, but require high volume commitment. These fences prevent leisure travelers from accessing business rates while ensuring the hotel secures base occupancy from reliable sources, optimizing yield across all segments simultaneously. Group sales, such as conferences or wedding blocks, provide guaranteed volume but often at a lower average daily rate. Before accepting a group, the revenue manager performs a displacement analysis. This calculation determines if the revenue generated by the group, including ancillary spend on catering and meeting space, exceeds the potential revenue lost by displacing transient guests who would have paid the higher BAR. If the group occupies rooms that could have been sold individually at a higher net rate, the group is rejected or the rate is renegotiated. This analysis is critical for maximizing total hotel profitability, not just room revenue. The final $300 bill often includes mandatory additions that increase the effective rate. Occupancy taxes, sometimes called transient lodging taxes, are levied by local jurisdictions and can add 5 to 15% to the base rate, depending on the city. These funds are collected by the hotel but pass directly to the government. Resort fees or destination fees are a controversial revenue stream, typically ranging from $20 to $50 per night. These fees are often excluded from the advertised rate but cover amenities like Wi-Fi and gym access, effectively boosting the hotel's net revenue without increasing the commissionable room rate paid to online travel agencies. The next generation of revenue management systems integrates artificial intelligence and machine learning to move beyond historical data analysis. These advanced algorithms process unstructured data such as sentiment analysis from online reviews and real-time weather patterns to predict micro-demand shifts. Machine learning models can identify optimal pricing points for specific room types, like corner suites versus standard doubles, maximizing the yield differential. This shift reduces reliance on manual overrides by the revenue manager, leading to more granular, automated pricing decisions that continuously optimize the $300 rate in real time based on thousands of variables.